There's one signal that tells you exactly when you should be entering a trade, and today I'm gonna show you that signal. It shows up on almost every single chart, and once you see it, you cannot unsee it. And once you get good at spotting it, you can make a ton of fucking money. Now, I just released my Telegram. I share all the plays I'm watching, useful trading tips, and a ton of value. The best part is it's completely free to join. If you want to check it out, I'll leave it in the pinned comment. Price almost never reverses in a clean sweep. Usually it does what's called a pullback. That pullback, that tiny hesitation, is the highest probability entry you could possibly have on a chart. Look, Bitcoin, 4-hour time frame, uptrend, pullback, then the run. Gold, downtrend, pullback, then the run. Microsoft, same thing. It's everywhere. But here's the thing. Everyone knows pullbacks exist, but what everyone doesn't know is how to trade them correctly. I want you to picture this. Price has been falling, suddenly strong buying starts occurring. It rips upwards. You feel the buyers stepping in. Price is breaking previous highs. Massive green candles are forming. You want in as the chart is going up, so you buy. This is possibly one of the worst mistakes you can possibly make. Here's why. If you buy at the highs with a tight stop, there's a very good chance price pulls back before continuing up, meaning this pullback alone would stop you out, and right after doing so, it continues up. So you were right about the idea of the trade, but you still ended up losing. So then you think, fine, I'll use a wider stop, which is an even worse idea, because now if the trend fails, this time your risk to reward is so blown out of proportion, so this time when you lose, your portfolio gets absolutely obliterated. You see the trap? Tight stop, you get shaken out. Wide stop, you get obliterated. This is exactly why 99% of traders aren't profitable. To solve this problem, you need to incorporate the pullback system. Why the pullback system works so well is because of one core idea: buy low, sell high. Like, if cavemen used to trade, this is the exact phrase they would be writing on the walls. I know it sounds simple, but even with the simplicity of the statement, most traders ignore it completely. Pullbacks give you one major advantage, and that advantage is risk to reward. All the top traders in the world understand risk management, and all of them use it. You see, instead of chasing a trade while it's moving upwards, you should always wait for a pullback before entering. Because in all cases, all of them, you'll be entering lower, which if you're entering lower, you'll be able to use tighter stop losses, where being wrong almost costs nothing. And if you're also entering lower, that also means your take profits are bigger. So in all cases, you have smaller losses when you're wrong, bigger wins when you're right. That's the entire edge. But none of this matters if you don't know how to do it correctly. One of the very first things you learn as a trader is uptrends and downtrends. It's almost like the sippy cup of trading. A chart that makes higher highs and higher lows is an uptrend. A chart that makes lower lows and lower highs is a downtrend. Simple enough. Everybody knows this. Now, you may be thinking, why are you even going over this? I already know all this. Well, what if I told you you're probably doing all of this completely wrong? Let me explain. So going back to our example, the chart does this, making higher highs and higher lows. And as we already stated, it's an uptrend, okay? But then something interesting happened. The chart starts heading downwards, which in this process, price makes this low and breaks right through it. And this exact point is where I see the majority of traders make the mistake. Since price broke this low, a lot of traders think we are now in a reversal and price is in a downtrend. So in return, they start looking for short trades because they now think price is gonna head lower. But what if I told you this chart is actually still fundamentally bullish? You see, sure, price made this low, but this low is actually not a low at all, or at least a valid one. Why? Because price never broke the valid low, which is right here. I want to make this very clear. In order for a low to be validated, it needs to break the previous high. If you do not understand this part of the strategy will not work.
You are done. Fired.
So say if price does break this high, we now know this is a valid low. Okay, good. So now price is in an uptrend, which means we should only look for bullish trades. The only time we should start looking for short trades is if price breaks this low. It can do anything right here. It can go up, down, sideways, literally anything. As long as it doesn't break this low, we are in an uptrend. Now say if instead of doing this, price did end up breaking upward. Since price did break our previous high, our new low will be transferred from this point to this one. So let me show you a real chart example. Here we have higher highs and higher lows. This here is the valid low because this low was the low that broke the previous high. Later, price drops and closes beneath it. That is our signal that price is now in a downtrend. One rule you cannot skip: you must wait for this candle to actually close below the valid low, just like it did here. If a candle wicks through it, then pulls back, this is a trap and is not a valid break. I cannot repeat this enough. The candle must close below the low for our system to be valid. So in our example, the candle did close beneath the low. So we know we are in a start of a downtrend and it is valid, and now we can wait for a pullback. Now, a pullback can technically form anywhere. That's the problem. We don't want to enter just because we see a pullback. And if you're just guessing which pullback to actually use, you're gambling. Which brings me to step 2. From my experience, there's a specific zone where when it forms, price bounces from it over and over. Supply and demand level. It's a pretty simple idea. There are areas where big buyers or sellers loaded up. When price returns to that zone, there's a very high chance it reacts. It's the same logic as support and resistance, just more efficient. To mark these zones, all you want to do is look for a sharp, impulsive move. The candle that started that move is the zone. Sharp move up, the candle that started that move is the demand zone. Sharp move down, the candle that started that move is the supply zone. So going back to our example, usually in most cases, while price breaks the previous valid low or high, it usually does so in a very sharp manner, which in this scenario leaves behind a supply zone. Take the last candle before the move kicked off, draw a rectangle from its high to its low. That box is our supply zone. Again, it's very important that this supply zone started a sharp move. If the drop was gradual and slowly dropped, it wouldn't be a valid supply zone. But in this case, the move was sharp, so we know we have a valid supply zone. Now it's time to enter the trade. We get the pullback we were waiting for, it enters into our supply zone, we set our stop loss slightly above the supply zone, we set our take profit at the previous low. Not only did we wait for a pullback, but we entered into a zone so strong that price does exactly as we thought it would and reverses exactly at this point, resulting in a beautiful winning trade. Let's do one more example to really make sure you understand the strategy. Here we have a downtrend, price is making lower highs and lower lows. So where we currently are, where's the high that price needs to break in order for this to be considered an uptrend? Is it A, B, or C? I'll give you 5 seconds to think of your answer. Well, this high was the latest high that broke the most recent previous low. So C is the high that needs to be broken in order for price to be in an uptrend. Price starts going up and does indeed break the previous high. I also want you to note it not only broke this high, but it closed above it, which is very important. So now that price broke the previous high, we now know we're in an uptrend and we should look for a spot to enter with our pullback system. Price spiked up pretty aggressively here, so we can take our first candle that started the spike, mark from the low to the high of this candle. This leaves us with our demand zone. Now all we have to do is wait for price to do a pullback and enter when it reaches our demand zone. Once it does, set your stop loss below the demand zone and set your take profit at the high. I also want you to realize something. This was an actual trade I took on NVIDIA, and if you look at our setup, the risk to reward is absolutely phenomenal. Our stop loss is super small, so if we do lose, it basically does nothing, and our take profit is massive, so if we win, our win is going to be ginormous. I entered this trade with $90,000. The stop loss is a 2% loss, which is only $1,800, but the take profit is a 20% win, which is $18,000. So we are risking only $1,800 to win $18,000, which if you consistently do this and are patient enough for the levels to actually get hit, the edge is so great, which is exactly why this strategy works in the long run. So we enter the trade, wait patiently, and price hits our take profit for an $18,000 win. That's the pullback system. If you want to see more of the trades I take, I post a lot of my trade ideas like this NVIDIA one in my Telegram. Again, it's completely free to join. You can get a ton of value in there. The link will be in my pinned comments. Start using the pullback system. You won't regret it. Thanks for watching, and I'll see you guys next time.